Thank you very much, Dan, and thank you for having us. It's a pleasure to be here, and it is a pleasure to be speaking about the topic that is nearest and dearest to my heart. Um, as Dan said in the introduction, I started Acorn Wealth in 2007, and the focus of almost everything that I do comes back to trying to be efficient. And if anyone's ever read the 4-Hour Work Week, you know there's a concept that's discussed in there that talks about the minimum effective dose. And I love trading. I'm extremely passionate about the market, and I love looking at charts and figuring out what that puzzle's telling us is going to happen next. But what I don't like is wasting time, and what I don't like is being frustrated and confused when I'm not getting clear signals. And so this is what we're really here to talk about today is how do we be really efficient, how do we systemize processes, and how do we, once we know what the systems are, use technology to automate a lot of that to find what we're looking for. So, of course, standard disclaimer up at the beginning. We'll talk about a lot of live stocks today, and we'll have a live Q&A obviously at the end where you can throw some curveballs at me if you like. Of course, this is for educational purposes only and not a recommendation to buy and sell. So we'll start out with some basics before we crack on into the market. I usually start every webinar I do, regardless of topic, with some of these basic slides, because I think that in order to set the tone of what we're going to discuss, I'll set some of the reasons why I feel strongly about certain points. Because one of the reasons why I think it's extremely important to utilize scans is so that you can utilize systems with consistent variables. In other words, you're trying to trade the same stock again and again and again and again and again. One of the reasons why scanning is so important in doing this, or why this is so important to do in your trading, I should say rather, is because most people fail in the stock market because they don't take action. And the reason that they often don't take action is because they don't have rules. They don't have systems. When we surveyed, I mean, we've probably taught upwards of 10,000 plus people over the years. We started off in only teaching one-on-one trading for the first 5 years of our business. We've only gotten into the online space and doing workshops like this in the last couple of years. But regardless of where people have come from, we've talked to all of our students and said, what did you struggle with most before you came to us? And the common, almost every single person had at least one of these in their list. Knowing exactly when to get in and when to take profits was something they struggled with. Selling too early before the stock took off. So they would get a stock that would go up 10%, and they'd lost 20% on the last trade, or the previous trade to that, it went up 10% and then plummeted down 30. So God, they're not going to do that again. So they sell it as soon as it goes up 10% on the next time, and then that one ends up going up 50%. And they think, the stock that I should have sold when it went up 10%, I didn't, and I lost. That turned into a loss. And then the stock that I shouldn't have sold at 10% ended up going up at 50%. I just can't seem to win. And these were some of the common things that people were frustrated with. Does anyone else in this audience had similar frustrations, perhaps? Maybe still? I know I have. I don't think any trader could say they haven't. Now, this comes back to, now look, I'm not saying that we have this magic system that's going to tell you which ones are going to go up only 10% and which one's going to go up 50%. I don't think there is a system out there that can do that. That's called a crystal ball, and it doesn't exist. But what does exist is the system of what will tell you what will get you the best, what's the best average profit to go for over 1,000 trades. Isn't that what we're really looking for? We're not looking to try and get the bottom and top of every trade, because that's impossible. But what we do need is a system to say, right, if I employ this strategy, and you know that 80% of the time, that strategy will find you a stock that on average won't go up more than 10, would you be happy selling at 10 every time? If you knew that that was the factual statistics. Would you worry about the extra 4 or 5% you could make on the other 20% of the trades? Probably not. You know, you want that set of rules that gives you confidence. And that is where people fail. They fail because they lack confidence, because they lack rules, or maybe they have too many rules, too many systems. What Acorn provides is, and what our approach is throughout everything we talk about today, and I'm sure there's a lot of our students here in the room by the looks of it. Hello, Faith. Hey, Scott. Look, it's to try and have start through finish systems to consistently make rule-based decisions. And this is where scans really play an important role. To have a simple and direct approach to the market, to target only the highest probability patterns, just like a poker player wouldn't play 2-6 offsuit. Why would you play that? It's a losing hand. So therefore, why would you play or trade a stock that has a low probability pattern? Just doesn't make money, doesn't make sense. And of course, we back that up with what I feel is the most important thing, which is one-on-one mentoring. In almost everything that we do, we incorporate one-on-one training at all price levels, because I could teach you something for 6 hours and it could cost you $20, but at the end of the day, if you don't understand it properly, you'll go away and lose thousands in the market. I mean, any strategy applied wrong has that risk. So where we come in and with our one-on-one is to make sure that everyone has not only heard me correctly and heard us correctly, but are implementing it profitably. So take calculated risks. That is quite different from being rash. So the stock market might be a chance. There's a chance of loss, a chance of winning, but that doesn't mean we're gambling. What we're all here to do is to create calculated systems. So let's talk about that. There's two things we're going to accomplish here in the first part of this webinar. Of course, the first thing I've accomplished is talking a little bit. I'm good at that. But in terms of getting into the technicals, there's two parts that we're really going to break this down into. We're going to talk about the market structure of basically how we identify what the chart is telling us, and we're also going to be talking about how we implement scans into that process as well. So firstly, in terms of the topic of today, stock market scanning secrets, the things I want you to be aware of, or the things that we need to, that we consider when building a scan, are these main points. Are the kind of different categories that go into the types of scans that we utilize. So let's talk about, obviously, the broad strokes of these. Price to earnings ratio. Obviously, that's important in a scan because what we're talking about is the perceived excitement value of the company, if I can put it that way. If a company's selling, they're making $1,000 a year of profit, but they're selling, at $1 million valuation, you know what I mean? Like, or if someone was selling at 1,000 times price to earnings ratio, their business is being priced at 1,000 times more than they make each year. That gives the impression that this company has some incredible growth potential. I mean, if you bought that company, the price to earnings ratio of 1,000 means you'd make your money back in 1,000 years. No one would buy that. But if the company is expecting to suddenly create the cure for cancer next year, then maybe you would buy a price to earnings ratio like that, if you see what I mean. So a high price to earnings ratio, it basically insinuates or implies a high degree of expected growth, extremely high. Now, so that's something we can look for to identify top flyers, stocks that may be very weak, and usually the ones that are the first to get knocked off their pedestal when markets start to correct, I should say. Okay, so of course, low P to E ratio companies are going to be less susceptible to that. Next. Insiders. Now, playing into, of course, insiders play a role. They're not always absolute. They're not always absolutely right. They're not always absolutely wrong. But, I mean, if I'm searching for a short, I would certainly prefer to see the insiders selling out instead of buying. If I was about to buy a stock, I'd certainly much prefer to see all of the board of directors loading up over the last 2 months at record levels than not, and certainly better than selling, right? So, and if we start to incorporate that with a P to E ratio, think of it that way. If you saw a stock that had a 1,000 times P to E ratio, in other words, extremely good expected growth, you certainly wouldn't expect to see all of the people that know the company best selling, would you? Right? If I'm out on the street saying my company's worth 1,000 times what it's making today, that's how good it is. Would you like to buy some of it? I'm getting rid of it at a flood sale. You wouldn't expect it. So dividend yield tracks safety. Dividend yield, of course, if you see companies that have a dividend, it's going to attract longer-term investors. There's going to be a reason for more people to value investors to buy. This can attract safety. This can be a healthy attribute to going long a stock. Of course, the lack of a dividend can be something that can attract selling. Because there is no reason to hold on. There's no extra benefit that, yeah, the stock might go down 15%, but I'm making an 8% dividend, so I'm not going to get rid of it. So dividend yield is something we can look at. And of course, then we start to get into some of the more technicals, where we deal with patterns. We deal with earnings. So if a stock is reporting earnings tomorrow or not, can be something that we do, is something we strategize around and scan for. These are called obviously earnings plays. There's strategy-based plays, where we're incorporating a number of aspects like indicators, patterns, so forth. We can also consider the short float, how much people are shorting a stock, A, to look for weakness, or B, to look for when a stock is heavily shorted. It can obviously go for very sharp short squeeze rallies. And then we go into performance and indicators. So I won't spend too much time going over every single point, but can everyone understand, okay, I guess the core basis of where we start to build scans from? We'll obviously go into that in more depth. And are there any questions on that so far? Because of course, just before we go to the next slide, of course the reason why we start to kind of what I'm doing here is I'm trying to lay out for you, much like a chef would, what are the ingredients in the kitchen that we have to cook with, and what we're trying to create is the perfect recipe. We're trying to bake the perfect storm. And we need to know, what types of things do we have to add to the mix. And it is about the cooking recipe is great, because that's really what we're trying to do. We're trying to find one recipe that really hits those taste buds, that really works well. A lot of traders try to cook everything. They try to trade everything, every pattern. Every stock, they get 5 stocks from this fundamental report, 5 stocks from this guy on TV, 5 stocks from a chat room and stock twits. Well, now you're dealing with so much, garbage, with so much different reasons why they're being picked, with so many different types of patterns. You're not a specialist in anything, and you're trying to fit, square plugs, round plugs, triangle plugs, all through the same slot, which don't fit. We try to create a perfect recipe here where we've got consistency. So one of the first things that we then need to consider is, how do we create that? What are the building blocks that go into the scan? Is how charts operate and what we're trying to look for. Something that is common in all of our and also all of our presentations is the idea of smart money. Now, obviously, the reason why these scans we're going to start talking about building work so well is because what we're trying to do, as Dan talked about at the beginning of this presentation, is we're trying to piggyback off the smart money. Now, there's no point trying to figure out what the market should do based on economic theory, because that's blown out of the water. I mean, since quantitative easing came in 2010, 2011, 2012, throughout the whole period where the economic EU crisis began and the markets didn't collapse, we've got a false market. Everyone knows that. I mean, I don't think anyone in this room would disagree that it's not a matter of if the market's going to crash, but a matter of when. Would everyone agree with that? It's not a matter of if, it's a matter of when. And that's been the question since, for a couple of years now. So I'm not saying it's going to crash tomorrow. I'm certainly preparing for it. But I mean, economic theorists would suggest this should have already happened a long time ago. What should happen isn't what happens. What happens is where the smart money wants to take us. And 70 to 80% of the market certainly comes from high frequency trading. In fact, that number might be closer to 80-90% these days of every stock being bought and sold comes from an algorithm making that decision. Nothing to do with the fundamentals, nothing to do with the management of the company, but what pattern is the stock in, and based on that pattern, where do we buy, where do we sell, and those types of specific rules. This is what drives markets in crashes, and this is what we've spent the last 12 years, right, reverse engineering to figure out what the smart money is in effect doing. Because it doesn't matter what I think the market should do. What matters is what the smart money is doing, and piggyback off that, even if I absolutely disagree that that should happen. If it's what is happening, I'm going to make money from it. So a couple of core principles that are going to go into this as we go into this scanning section here. Something that you must understand if you're going to trade stocks or options or Forex or futures. What you absolutely have to understand is what moves the market. So obviously the first thing we've just discussed that moves the market is smart money. That is where 90% of the volume comes from, and at the end of the day, volume is the only thing that moves markets. So who controls the volume? The smart money. How does the smart money make decisions? Well, the absolute most important thing that I could teach anyone is to forget everything about finance. Forget the stock market's got anything to do with companies. And if you want to make money in the market, the first thing we need to understand is to look at the stock more like a moving entity, a creature, an animal moving around the screen. And we need to understand what personality or structure that stock has to predict where it's going to go next. And to do that, the first true statement that I teach people in trading is just look at the stock as like an animal and approach the chart with the idea that that stock will not change direction at all unless it has hit a horizontal support and resistance level, a trend line resistance level, or a moving average. It is one of those three things. So you're kind of putting your detective hat on and you're saying, right, why did that stock change direction? And to do that, this tells us what we need to know in order to trade it, and also what we might be looking to scan for. So let's use an example. Anyone here like Netflix? Anyone trading Netflix at the moment? Let's bring this one up. So, we're going over to Netflix. Okay. So, a quick question to the audience. When you look at a stock, if I said, hey, look, Netflix is a great short, how would you decide whether you agreed with me or not? Would you look at news? Would you look at trend? Would you look at indicators? Pardon me. What would be the first thing that you would decide if I would say, hey, we should short Netflix tomorrow? Overall trend, the pattern, trend line. Okay. A few good responses. Candlestick pattern. All right. Thank you. The first thing that we need to look at, in my opinion, is we need to look at what I just talked about a second ago. We need to look at what is support and what is resistance. Because there are two types of core patterns in the market. There are oscillating patterns and there are momentum-based patterns. Now, if you are trading, these are as different from each other in how you find them and scan for them, in how you enter them, where you place your stop losses, how you manage your targets, what indicators you use are completely different on these types of patterns, right? For example, let's just say this red line is a moving average. If you are dealing with an oscillating stock, you buy on the way down. Generally, when you buy an oscillating stock, it is when the stock hasn't even gone up a single %. It is dropping still. You are catching the falling knife. And when you sell it, it hasn't started going back down yet. You're buying the support that matters, and you're selling the support that matters. In an oscillating stock, by determining that is its personality, you buy the horizontal support and you sell the horizontal support. You don't wait for it to break out. If you think it's going to go higher, you sell it here and you buy it back on the other side, because probability tells you that if it's oscillating, it won't break through. Okay, so simple rule. With a momentum strategy, the oscillating levels don't matter. The horizontals aren't strong. That's why the thing kept falling, lower and lower and lower, crashing through all of those. It's also why the thing will go higher and higher and higher, breaking through all of those as well, because the oscillating levels don't matter most. The moving averages matter most. So you don't buy it when it's dropping. If it's oscillating, if it's momentum, you buy it when it breaks the moving average. So these are very critical things to understand when we're talking about scanning or any kind of trading, because it significantly affects the strategy depending on what type of personality we're dealing with. So I really think it's important. I talk about this first before we get into the scanning side of things, because I'm not going to hand you a loaded gun if you're going to turn around and fire it in the wrong direction. You've got to understand this part of the process first to make everything else valuable and powerful. So the very first thing we do when we look at a chart is determine what type of support and resistance matters for this. I'll say one more thing before we go on to this, sorry. The one other thing I was going to add to that is about indicators, because I know a lot of people love indicators. If you're dealing with an oscillating stock, you use Bollinger Bands. You use CCI. You use Kelton channels. You use things like that. You do not use moving averages. You do not use MACD. You do not use those directional movement indicator systems. So that's why, again, the differences are significant. Okay, so let's move on. So let's look at something like Netflix. The very first thing that we would need to do, as some people suggested, is we need to determine what is the trend. What is the trend line? But here's a question. Or how many people here struggle with knowing where the trend line is? How many people do this? Okay, maybe it's that. Maybe it's that. Maybe that's the trend line. Hang on. Maybe it's this. Wait up. Maybe it's that. Where is the actual trend line? Or maybe it's this. Anyone feel like this? Anyone feel that they find up looking like they're just drawing lines aimlessly on their chart? I know a lot of people I talk to struggle with this, and even if they don't know it, they do. Trend line drawing is not subjective, in my opinion. There is absolute rules as to how to go about it. And it's very important you get this right as well, because if you don't draw trend lines correctly, if you haven't drawn your trend lines that define the stock's personality correctly, then you do not know at all what pattern the stock is in. If you do not know the pattern the stock is in, then you do not know how to trade it. Not anything, maybe in a day trading, maybe for a few candles, but you'll have no idea about how long, what the statistical probability is over 1,000 trades of where that should go, whether it's 8%, 10%, or 50%. You won't know where to put the stop loss, other than just picking arbitrary numbers of a 3-to-1 risk ratio. Oh, there you go. I want to make 10%, therefore I'll risk 3. No, that doesn't work. Sorry. You don't get to choose that. Your stop loss should always be behind support, not where you arbitrarily want to pick it. And your target should always be at resistance, not where you arbitrarily would like to sell it at. Just in my opinion, the stop loss and the target is never something you get to choose. The market tells you where support and resistance is. The only thing you get to choose is your entry point. So for all of that to work, we have to know where true support and resistance is. To do that, let's erase all this garbage. We need to know how to identify that correctly. The way we do that is to start from left to right. So one trend ends when another one begins. So we can see here that if we just start on the left-hand side, it may not be valuable to us in terms of trading this knowledge, in terms of picking a trade out now. But what this does for us is it allows us to determine when the pattern ends and another one begins. So left to right, all right, there we go, that's where that pattern ended. So going left to right, so we don't do this because then we'd be jumping over that. We always go left to right and connect the peaks in sequential order as they occur. Okay, so as you can see throughout this period, we're oscillating. That 9-day moving average didn't matter at all, and if you were buying every time it went across it, you would have gone broke. All right, let's continue on. Okay, so then we go into momentum mode here. As you can see now, the 9-day works very, very nicely, and that explains the entire drop. So here we don't need to draw trend lines because there isn't one. The trend line is the moving average. That then stops working here, as you can see. It goes back into oscillation. The 9-day doesn't matter at all again. This is not momentum. This is oscillation. Therefore, we define the extremes of the move. There we go. That connects every reversal point perfectly. So there's the checkpoint of our test. Okay. Then we look at our resistance levels. Okay, what type of pattern was that? Well, technical analysis tells us that is a rising wedge pattern. And in a rising wedge oscillating pattern, and in fact with any oscillation pattern, it's the rule of 3 touches, and then the support is useless. 1 touch, 2 touch, 3 touches. There's our break. So There's the shorting opportunity there on earnings. In fact, we took that opportunity. And we'll talk about that later, about options during earnings. Okay, so then we have, then we rally up. Okay, so now going left to right, we can see that a new pattern has begun after this one has finished. So now we know to identify these tops and these bottoms. Okay, so what type of, everyone, what type of pattern do we have here? What pattern do we have there? Not a pennant, a falling wedge, exactly. A pennant will typically be sideways, Michael, but good try. But the way we apply it is very similar to a pennant. And a rising wedge, what we do, pardon me, a rising wedge, what we do is we measure from the top of the wedge to the bottom of the wedge, okay, and then we duplicate that from to the breakout point. Now, so what that tells us is that what probability tells us, what rules tell us, is that Netflix should break out. If it breaks out from this level, then it should get up to about $115. Now, we actually picked this on August 10th. That was the day that we actually picked this. And the trade alert was if it broke this resistance to look at some $100 October calls. And as you can see, we've had that break. We've moved really nicely right now. We do need to break through. I think it's the 200-day moving average. Yeah, hasn't broken that yet. That's going to be its obstacle. But this therefore has a good probability at this point, with a low risk of only a couple bucks for a for $12 potential reward. So $3 risk for $12 reward. That's 4 to 1. That the rules, based on knowing what the pattern is, tells us we should get at least up to this level, and that's where I'd sell it at 110, because then we also have a double top that occurs. And if we also look at our Fibonacci's, you can see that's also right where we start to run into these kinds of problems as well, of the 61.8. So I'm not going to bother challenging a double top and a Fibonacci when I can just get out with a really nice profit there at 110. So this is an example of an oscillating pattern, and one we found in our scan just in August. And of course, if we go and have a look at one of the key things that I look at always, have a look at the insider buying. Now, I just want to bring your attention to this. If you look at the insider buying here, can everyone see that we have had substantial, unprecedented insider buying coming in on Netflix? Now, I don't know if anyone's followed Netflix for a while. I always look at it because in every webinar we do, someone always asks me to look at it. I can tell you that Netflix has had insider selling with almost no buying for as long as I've been looking at it, for years. I've never seen this type of buying on Netflix, and because we have a strong pattern with strong insider buying, in one of the only sectors, or excuse me, I should say not sectors, but in one of the only industry groups where there's actually insider buying. Netflix is in the music and I think it's a music and video stores industry. There's only 4 industries, now not sectors, but there's only 4 industries in the entire stock market that have more buying than selling, just so you know. Not sectors, but industries. There's only 4 that have more buying than selling, and music and game stores, video stores is one of them. Netflix falls into that industry group. So we have a strong industry, we have strong insiders, we have a strong technical pattern, we have good risk-reward ratio, and therefore this would be suitable as a trade, right? You can see what I'm getting to in your mind, hopefully, of a checklist of what a perfect trade looks like. Let me show you another one. Now, this is also an oscillating stock. Now, one of the other areas that that has had one of the only other industry groups in the entire stock market that's had insider buying has been auto dealerships. So, what do you think I did? I went and scanned for stocks that were in the auto dealership industry, which had a low price to earnings ratio, which had good insider buying, right? Which had these types of things going on, that all of the ingredients that would make it an attractive stock with a very high probability pattern. So when I start to build, hey, if I know what I'm looking for, I'm going to go scan for that. This took me 5 seconds to find. I ran my scan, and this stock came up as the #1 alert, Penske Automotive Group. So let's start with, let's use our rules. Let's say, okay, so my scan tells me this is a great stock to go long. So how do I say whether I agree with it or not? Well, firstly, is it oscillating or is it momentum? Well, the macro pattern, right, the larger term time frame pattern is oscillating, because what we have here is an Eve and Adam double bottom. Question from Scott. There was more recent selling by 2 guys versus insider buying 1. Does that matter? Yes, because those are the same people that have been selling every month. So what I'm looking for is unusual activity. The selling that was happening on Netflix was consistent. What I'm seeing in this buying is unusual, and it's large. So looking for the unusual activity. Okay, so so here we go. So now, does everyone understand the difference between an Eve and Adam double bottom and an Adam double bottom, and those different types of things? That's important, because we need to understand what we're dealing with. Are we dealing with aces or a 6-2 offsuit? No? Okay. Very important. You need to understand your patterns. Patterns, again, the only thing that tells you without guesswork what to do, how to trade, where to set your targets are patterns. That's the only concrete rule set that gives you no gray area, because a pattern has specific rules of how to trade it that work. So you have to know your patterns if you really want to make serious money in the market. And then, of course, I'll tell you that then you need to know how to scan for them. Now, the difference between these types of patterns, just checking the time, all right. The difference between these patterns is that an Eve and Adam double bottom, you have an Adam and Adam double bottom, you have an Adam and Eve double bottom, and you have an Eve and Eve double bottom. Now, of course, this applies for double tops as well, Adam and Adam double tops, Eve and Eve double tops, etc. Now, there's only 2 of these patterns you would ever trade. You would never trade an Eve and Eve double bottom. On a ranking system from 1 to 100, this ranks 49 out of 100, 1 being the best. You would never trade that, ever. Because why would you, knowing it's low probability? You could, it could make you money, but why the hell are you if you're trying to deal in the business of making money every day, why would you compromise and trade something garbage when you could trade a 13 out of 100 being an Adam and Adam, or one of these as well? What you're looking for is the sharp reversal. That's what makes this powerful. The deep wide reversal makes it weak. So on both of these, our launch point is a powerful one, and that's what makes these tradable opportunities and what makes those not tradable or not worth trading. Have to know that. So here we have an Eve and Adam. So yes, that's a great double bottom. That tells us that based on that pattern, we measure from the bottom to the top. We then duplicate that line, and that tells us that we have, based on a double bottom pattern, a target of $52. What we needed to see happen was it to break 41, and as it did, that's where we recommended that to our students and in our trading room to look at the $45 November and February 2017, November 2016, February 2017 call options, which are now up 100% since we alerted that back on August 11th. Now, once again, so now we have, think about recipe. We have a strong industry. We have a, we'll go and have a look at the other breakdowns here. Hang on. We have a low price to earnings ratio, 8.8. We are in one of the only industries that has insider buying, one of 4 that has more insider buying than selling. We have a low price to earnings ratio. We have a very strong technical chart, most importantly. We have a risk reward ratio of the stop criteria was 38.53. So what was it? $2.47 of risk for $11 of reward. Can anyone do the math for me? $4.5 basically to 1. 4.5 to 1 risk reward ratio. Excellent. And then of course we go and have a look at our insiders. Lo and behold, check it out. Now, these, thanks Frank, sorry Chris. Look, basically, there is no insider buying happening hardly anywhere. If I was doing a different workshop tonight that I've been talking about recently, it's called Capturing the Crash, there is unprecedented selling. There's more selling happening. There's about 50 to 1 ratio right now of selling versus buying, and that's been consistent for 4 months now in the stock market. That's just another reason why we're very worried about the market's scenario. So when you come across a stock where it's the complete opposite, where there is absolute loading up happening from the owner himself and his corporation, and then you in fact go in to look at the CEO's track record, and you actually see that all the way back to 2004, he's never bought a single share insider, not a single insider transaction, and then all of a sudden buys tens and tens and tens of millions. That's a checkpoint that we look for. And there you go. So what we're doing, these are examples of how we start to build scan, is you have to start thinking with the mentality of, well, what is the perfect recipe? What exactly are you looking for? Now, I mean, can everyone see that as I start to break down some of the components of this trade, you can see why these trades make sense? Now, neither of these trades have guarantees to make money, but no trade does. But if you were all sitting in the audience, would I see you nodding your head, you know, that this trade makes sense? This is a rule-based trade where if you had a checklist of things that made it good, you'd be basically checking all the boxes. What else do you have to go off? I mean, some magic indicator, some crystal ball that you buy. Like, you know, there's none of that exists. All you have at the end of the day is to keep your sanity is a checklist, something that keeps it simple and say, right, what exactly is the perfect trade, and how do I find that, right? And then just go with it. My last little bit of rant before we go into some of the scanning stuff. You need to have rules to keep your sanity. The only rules that I know that work are patterns, which means you need to know support and resistance. Once you know the best patterns, then you can scan for them. That's the whole process. And once you have rules and patterns and scans, you never have to worry about whether you're right or wrong again. You never go to bed wondering whether you made the right decision and stressing about it, putting your head in the sand the next day and just hoping it works out. That's garbage. That's not work. Don't trade if that's how you're living. When you make a trade, don't worry about whether it was the right or wrong decision or whether it's going to work out or not. A good trade is one, not necessarily one that makes you money. A good trade is one that follows the rules. A bad trade is one that's not by the rules, even if it makes you money. So let's move on and talk about, so I've talked about some of those rules. I'm going to skip through some of these slides. All right. So a couple of questions. How do you scan for the highest unusual insider buying? There's a number of ways to do that. You can do it through technicals, which is a method that I use, which is called the Smart Money Indicator, and I'll show you that. You can also research it through FinViz. I'll show you a couple of things you can look at that for that. Okay. How do I get the risk of $2.47 for the PAG trade? Well, if you enter at $41 and your stop is at 28.53, 28.53 plus $2.47, 38 is $41. 38.53 plus 247 is 41, which was the entry criteria. So therefore, entry criteria to the stop criteria, you get the risk of $2.47. Okay, I see a few questions about what expiration to buy and things like that with options. If I can, I'm going to leave it towards the end because we'll have plenty more examples to also look at then, depending on our time. We've got, I think right now we've got 25 minutes left. So the good folk over at Winvesting have given us a nice, good time slot. So let's go over to scanning. Oops. Once you start to build an idea of what you're looking for, you can build a scan. You know, there are great scanning tools out there that are inexpensive, incredible charts. The one I'm using is great. TC2000's fantastic. You can program your own scans in Think or Swim. You can get Metastock and program scans. TradeStation. There's zero excuse for someone to not have scanning software in today's era. There's so many good tools that are inexpensive or free that you can use. And so if you're not scanning now, I would seriously ask the question, why not? Because if you know what you're looking for, why aren't you letting computers do the job for you? If you don't know what you're looking for, then it's time to maybe step back and figure that out. Because there's an old saying that says, if you don't know what you're looking for, then any road will take you there. And this is why people end up trading so much garbage, because they're opening up their floodgates and saying, any stock out there that I should buy? and they go and buy the first one that comes their way. It doesn't work out, they get, blah, 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 blah. So once you know what you're looking for, let's scan for it. So just think about that. So when you start to think about how you want to build your scan, this is the process that you want to then go through to build out your idea. Okay. Now, everyone at this point, I mean, you've all come. I'm sure most of you aren't brand new traders. That never looked at a chart before, at least. I'm sure most of you have heard the idea of plan your trade, trade your plan. That is absolutely one of the most important things to do. If figuring out support and resistance, and therefore the pattern, was the number one most important thing, the second thing would be to always have a plan. There's no such thing as a wrong plan. Warren Buffett said that himself. There's no such thing as a bad strategy, just bad traders. Even if you have a bad strategy, if you stick to it, you will make money because the numbers will work over a period of time. So the same thing with a scan, we need to develop a plan around it. And to do that, we start with an idea. We say, okay, what is the idea around the scan you might want to develop? And let's say that the idea is that we believe right now the market is falsely strong and may have rallied today, but we believe that some stocks are at the beginning of their downward descent. Let's say that that is an idea we want to start with. See, just like a science experiment, there's our hypothesis. Okay, so what's the next thing that we could build out from there? All right, well, therefore, let's look, now, not all markets crash at once, right? They never do. I mean, the market continues to go up. Oh, let me use a different pen color. That's horrible. Anyway, let's get pink. Markets go up. Thank you. I won't forget to pack my clothes. There we go. All right. Markets go up, and then they crash, right? But not all stocks crash at the same time. In fact, what generally happens is you see the weak sectors start to drop off first, right? So it's a gradual process. So if we believe that the market's at, let's say, this point here, then we want to figure out, what stocks fall into this category, and this category, and let's short the hell out of those and buy puts on those, and then let's go long and buy calls on everything else that's still on that purple line that still has another 10-20% more of upside before it starts to drop. That's really what the trading strategy should look like, right? So let's look for the weakest sector. Let's go for a high P/E ratio. Let's look for insider selling. I won't worry about the price to book ratio. Let's just look at that. So we can start with that, right? So one way to do it, we can go into FinViz. You can go into a screener, and you could do that. You could say, well, I can tell you for a fact that application software, for example, has got significant insider selling. Massive, massive, massive insider selling. So, all right, let's go down to that industry group, application software. Alrighty, let's go to all. Let's go to a high P/E ratio of over 50. Okay, we've got 24 stocks now that fit that category. Let's look for insider selling. 16. we could, let's say that we don't want to see a dividend yield. We've talked about this before. So no dividend yield. All right, good. All 16 don't have one anyway. Okay, so now we have let's go into the basics here. So I'm going to go to my custom first. I'm going to look at, I've customized how these stocks display. Have I? Hang on. There we go. Yep. So I'm going to sort by the highest amount of insider selling first and down. So as you can see, what do we have here? We've got Adobe, we've got CRM, we have SPS Commerce, Eli May, all of these log me in, which of course is a competitor to the software we're using right now, GoToMeeting. Sort of similar, anyway. And what we can see here is we've got high P/E ratios, high amounts of insider selling. So basically, I mean, this is a very small list, so I would just go and have a look at all of them. They've all got good market caps as well, so there's going to be plenty of options, plenty of opportunity to trade at the stock or the option. And yes, we'll talk about that soon, Efran. We can also see the short float. I mentioned that to you in the beginning of this workshop as well. So you can see that a lot of these also have heavy short floats. 288 P/E, insider selling, a 10% short float. Here, 35% negative insider selling, 6% short float, 128 P/E. So let's go to basic, and it's going to keep it in this order. What we can now do is we can apply our technical acumen to look for timing. So this, by the way, would be a fantastic list just to put on your watch list waiting for timing. This one, as you can see, isn't ready yet. I mean, it's starting to look weak. It's in a long-term rising wedge type of formation. Oops. And I always like to have my money flow indicator up on the screen. I talked to you about how you can scan for smart money, selling or buying. This is the indicator you use. It's excellent. And if it's above zero and going up, that tells us buying. If it's below zero and going down, that tells us selling. So divergence, of course, is most important. That's what we're starting to see here. You can see that the levels on the money flow peaked at basically $98. The stock has continued to go higher. Money flow can't get as high. So you can definitely see we have the evidence of a rising wedge. We've got a rising wedge with a rising channel. Both are bearish patterns. I mean, but you wouldn't, in a rising market, you don't short resistance on the way up. You wait for it to break down. You wait for the break to occur first, and then you short it there. One second. Yeah. All right. So Adobe would be a great short if we broke $100. So you'd throw that on your watch list and you keep a close eye on that. Let's have a look at the other ones. CRM. Well, that would have been a perfect This actually would have, this was in our options during earnings scan, because for the same reason, I mean, well, some of the same reasons, you can see that was right, had rallied straight into resistance. Again, look at the insider transactions, negative 76, huge P to E ratio in a very, very weak industry. There's a shorting opportunity from 80 down to 74. Another stock, by the way, in our options during earnings scan, Lululemon. We picked this one we were in our trading room there on Tuesday, August 30th. We said, look at buying the $75 September puts ahead of earnings. Plummeted. Our target was $69. Ended up at 68.57. Easy. This took us literally no more than 5-10 minutes to find. One of the top stocks in the scan. Anyway, we'll come back to that. So you've got SPSC, same scenario, long upward channel, waiting for that to break down. How does ZFGN look to you? Less. It looks good, but it needs to break out first. I think I'm looking at that as a long ZFGN. That's one we're already covering in our trading room. Log me in again, needs to break down, but these are all excellent potentials that are all in long-term bearish patterns. BSFT, Broadsoft, long-term upward channel that's bearish, 1 touch, 2 touch, 3 touches. That support's done. Next time it touches that support, that will be the time to short it, and you're going to have a $50, $52 down to, you're going to have about a 15% potential. Your target would be about $35 from here. That's basically the equal distance. So roughly you're talking about a trade from $42.50 down to $35. So $7.50, almost 20%, and that's where I say go and buy some, July $40 puts if it broke down below that level. These things just pop out at you. You get this trades when you've already got the weakness predetermined by the scan. Red Hat, already one that we picked out as a short. That's ready now. Synchronos at resistance. If the market broke down, this could be a possibility. But as you can see, this is how you can start building out the idea. You can start to, whatever your idea is, you can start to build that into it. Now, this is one methodology for scanning. A second, and of course, this is where you can then, once you find a stock that you like, that's when your technical analysis skills kick in, and you start analyzing the stock and deciding if it does look good for a buy or not. And of course, the other big thing, the other big checkpoint is looking for patterns, where you can scan for patterns. Now, this is an excellent resource as well, where you can incorporate that. Now, when you're scanning, you don't want to be too particular with too many things. There are certain, basically, when you're building a scan, there are two different types of criteria that go into that. There are conditions and there are triggers. So a condition might be that it has a high P to E ratio. A condition might be that it has no dividend. A condition might be that they have a good cash forecast. These are all conditions. They don't change really every day to day. They basically describe the company. They're descriptives, they're conditions. Triggers are things that are saying, yesterday I wouldn't have shorted it. Today I would load the hell up on it. What made it an excellent trade now and not yesterday, not next week? What makes it awesome now? So you can only really ever have one trigger, maybe two, but as many conditions as you want. So Um, keep an eye on the time. Got about 9 minutes left. So with these types of things, you've really got to consider, well, what are the core descriptives. So you might say that you want a high P to E ratio, no dividend, but you don't care about the industry. All right, you're going to say any industry with insider selling. But what you might care about is you might care about the pattern, and this is where you can incorporate high probability patterns. The highest probability pattern to short something in a bull market is a head and shoulders pattern. So you can then go into patterns, and it doesn't have a lot. It just has, and really, FinViz isn't the best site. In fact, it's a pretty poor site for finding patterns, in my opinion. But it is an excellent place to start if you don't have any experience. I'm just trying to figure out why this isn't loading. Hang on a second. All right, so pattern, head and shoulders. All right. Take the dividend yield off. So, for example, there you go. Using the pattern with insider selling and a high P to E ratio, FinViz says there's GHM. Now again, I don't like using FinViz for pattern scanning, but it is a good place to start. You could also, I guess, look for an upward channel, which is also bearish. There we go, strong upward channel. That's probably a better type of thing that FinViz works for is channels. Come on, what's going on here? There we go. And this is where you're going to start being able to see. So there's Broadsoft again. There's BSFT, which we've already found in the previous scan. Johnson Controls. Yep, that would be a half decent short if it could break down below its horizontal support. That's already come out of an upward channel. REXR, industrial REITs. Industrial REITs I wouldn't touch. If that was a retail REIT, I would. Anyway, this is the process you go through. As you can see, what we're now doing is we're incorporating a pattern in as the condition, and then you would be looking for the breakdown through support and all the technical analysis skills you've been taught to figure out the trigger. Now, we've only got about 5 minutes here, so I'm going to fast forward a bit. We don't have time to go through as much as I could teach you here, because that's kind of, I could talk for about 10 hours. Let's kind of break down to what next steps are. I guess the most important thing that I hope that you've been able to take away here is that you know the scanning is, you know, if you start incorporating scanning into your day, it doesn't mean you're going to find every single stock that is going to go up tomorrow. But you don't want to. The only stocks that I trade are ones that I find in my scan. I devote one hour max to looking for opportunities a day, and this is what I do for a living. It's what I've lived off for 13 years now. My full-time job takes me 1 hour. I guess that's what I'm getting at. Could I, in that 1 hour, I find all the highest probability stocks that I want to trade. Now, if I looked for another 8 hours and spent all day doing it, would I be able to find more opportunities? Yes, of course I could. But why would I want to do that? You know, when I can scan the market in 20 minutes and find that the majority of where the best valuable trades are, why would I spend 10 times more than that time finding the other 20% of the trades I've missed? It doesn't make sense. That's the definition of wealth in the 4-hour work week. Is who's the wealthier person? The one who makes 100 grand a year working 60 hours a week, or 60 grand a year working 10 hours a week? You know, in trading, I feel it's the same. You know, why would I spend 6 hours a day looking for stocks that are going to go up 10% in a month, and I could spend 30, 40 minutes in a day and find moves of 6 to 8. It just, that's efficiency. My time is worth more than a 20% margin that I give up to get that back. So the next steps with this, I hope you can see today, we've basically taken you through the process of what is, how do we see the market? What is the market structure? How, therefore, do we work from that to build what types of ingredients we're looking for in a recipe? And then what types of tools do we start to take that recipe and then build it into the format of a scan? Now, I've given you some ideas, and I've shown you, basically the process of how to develop ideas and what you want to, types of things to consider. In this course, this is a 4-module course that where we will teach you the scans we use and basically do that work for you. So in this workshop, there are 3 on-demand lessons you receive immediately. You receive them today. And those are going to take you through, they're on-demand lessons we've recorded over the last 2 weeks. So they're very current. And this is where we actually teach you several different scans, the methodology of how we developed each, all the ingredients. We give you the ingredients. We give you the programming. So if you're using TC2000, Think or Swim, Metastock, Incredible Charts, whatever program you're using, you can program it right into your own platform. We give you the indicator, the smart money indicator that we use. We give you the settings that we use for some very specific FinViz scans that we teach you. And then we show you, once you run the scan, exactly what you're looking for when the results come up. This is just an example of some of the scans covered in this 4-module course. As I said, 3 of the modules are on demand, and then we're going to be doing a big live master session next week on Wednesday, which will be 2 hours long. And that will be live. So 3 on demand, 1 master live class, and the scans you'll be taught are the inside the insiders. That is awesome. That is where we will teach you how to find what the biggest amount of selling is, where the industry, what industries are selling off in boatloads, which ones are buying. How to find that, and then how to develop the scan around that to find the highest probability shorts. Lululemon was one of those. As I said, Netflix was one of those. There are Bristol Myers Squibb was one of those that we found in that scan. Head and Shoulders pattern. We picked that out as a short on Tuesday, August 2nd, before it plummeted from $75 to $61. That took 10 seconds to find. It was the second stock in the insider's scan that you'll learn. Scouring for the short squeeze will show you how to find stocks that have the potential of having massive short squeeze rallies. Rallies on bad stocks that go up 30-40% before crashing back down again. Those are really cool trades for a technical trader. Smart Money Extreme Scan. We teach you that as well. This is where we're going to, this is the exact stock that you'll see us teach you in that scan. In the lesson that you'll be able to watch today, if you want to watch it then, the number 1 stock that we selected was this one, AKG. We selected this right here. This is called a Smart Money Extreme Scan because we're looking for stocks that are at a level that are set to rally purely because high-frequency trading is going to buy them. And we said this will rally from $3.80 to $4.20 or $4.60. Those were the 2 targets. From $3.80 to $4.60 in 1, 2, 3 days. That's what, 30% in 3 days. Easy. The number 1 stock we selected, you'll see us do that analysis, start through finish, and teach you the scan to find it in the on-demand lesson you'll be able to download today. Options during earnings, how to create your own scan, and all of this comes back to incorporating this as to once you've run the scan, how to identify the highest probability patterns. Your bonuses we're going to include in this, and then I think we're pretty much out of time. I think I'm just going to look at the chat box there, Dan, and I think we're out of time, aren't we? Yeah, but the bonuses we'll include for you, because it's obviously it's going to take you a little bit to get familiar with the scans and practice the scans and so forth. So in the meantime, what we're going to include for you is a video that you'll also get today that will show you all of the positions we feel are the highest probability setups with entries, exits, stop losses, and options of and where they're all at right now. You'll get a video of that as well, summarizing how we picked it, where it's at, support resistance, the scan it came from, the pattern it's in. You can basically hit the ground running, so that if you're looking for some potential trade setups for tomorrow or maybe later today, you can look at that right away and say, right, there's a trade I like, and there's some really, really good ones. This is the one that we actually sent out last week. This was an entry at $1.03 with an exit at $1.43. On the stock alone, that's 43% in 3 days. That was the #1 alert we sent out last week on Thursday. We sent out 2 new ones last night. Our results right now are killing it. You should make the $97 back in, even if you just take one trade from the scan that we're currently looking at. You'll get a live class review Tuesday, Thursday at 7 p.m. which will be a live review of all of these positions we're discussing. And you'll have the option of also adding that for a whole month for $9. Once you register, you'll get that option. It'll come up on the screen. Do you want to add our Smart Money Scanner series for $9 for a month? That's what that'll get you. Videos and alerts every single day for the next month telling you what we're trading. Entries, exits, options. So if you want to follow what we're doing for the next month while you learn the scans, highly recommend it. Only $9, and it gets you the live classes every Tuesday, Thursday. And the final bonus is we'll also, as mentioned to you, one-on-one is important. It's not just what I have to tell you. It's about whether you're able to use it properly and make money with it. So the last bonus we'll include for you is we'll give you a one-on-one lesson with us to cover whatever questions you have. Maybe just run the scan live with you and make sure you're picking it properly. And we'll do that one-on-one session with you to consolidate everything and all of that, as well as an open range trading session. I don't have time to talk about that, unfortunately, but that is really awesome. That is all included with your package. So strategy, scans, implementation, mentoring, everything. If you remember, I told you at the very start what Acorn specializes in and provides to make sure you're successful with your money. I'll leave my information up here on the, I won't read through the testimonials and things, but I'll leave my information up here on the, I mean, it's awesome. I wish I had time to read it to you. But if there's any questions I haven't covered, please email me or give us a call. Comment from the audience: as a brand new member since yesterday, John, you guys are just amazing with the information I already received. Wow. Thank you, BH. So I'll leave my information up on the screen. I'm not sure if we're out of time or not. Dan, how are we doing?
John, I think you're right on time. So thank you very much.
Okay. Well, everyone, thank you very much for coming in and listening to me share my ideas with you for the last little bit. Again, these are 3 on-demand courses you'll get instantly, and the course, then there is a live lesson that comes on the 14th at 8:30. So that is those are basically what you'll get. DT says, John, John's ideas are great. Thank you. Thank you, DT. I think you're just new to us as well, aren't you? I promise you, this is, you will see it when you go through the on-demand lessons that we recorded over the last few weeks, where we pick these ideas out. Costco was another one. The Costco short. COST, we picked that in the lesson that you'll watch there under the short scan. Markets going up, Costco's going down. That was one we picked from the scan. Again, a good stock trader should make money shorting a market that's going up. Sears Holdings from the scan. Short of that, that's going down in a market that's going up. Yeah, you can't believe how exciting it is when on a market that goes up 2%, you've got shorts that are making you money while your longs make you money. You're making money in both directions on the same day because you're in the right stocks. And that's where scans come in. All right, I won't tie you up any longer, guys. Again, here's the information on the screen if you would like to get involved. I hope you will. Give us a shot. And again, thank you so much to everyone at Winvesting for organizing such a fantastic event. Hope to see you all again sometime soon. Thank you so much, Dan.